What are you thinking about for 2025?
The economy is still strong. We're close to full employment. The municipal revenues, some of the revenue streams that I mentioned as a whole, are flirting around all-time record highs.
Welcome back to another Market Insight, joined as always by Aaron Tuttle. And this month, second feature, we have a special guest, John Miller. He runs the municipal bond team at First Eagle. Prior to that, he ran the largest high-yield municipal bond fund at Nuveen. Incredible track record, top decile performance. A couple years you were top 1 percentile. So he's going to tell us how that was done and give us an outlook for this year. Thanks so much for being here.
Thank you very much for having me.
Well, like I said, was one of the largest funds, $28 billion. I want to hear the story, how you built that.
Sure. Well, I started in Nuveen in the early 90s in the credit research department. So I learned muni credit from the ground up. Nuveen and I together wanted to enter in more fully to a credit-specific, credit-sensitive product to get the most value out of that segment of the marketplace for shareholders. And so I was asked to start a dedicated high-yield municipal bond product in the year 2000. So promoted from a research background into portfolio management. So started small, just seed capital, and started working with financial advisors to tell the story of muni credit, and just built a track record and assets through an open-end mutual fund structure over a 23-year time period. Over that 23 years, there's been many movements in interest rates, in Fed policy, in different credit components, and fortunately, we've made as a team good credit calls over the years, which have enhanced performance and yield, and increased the size of the fund and the fund's notoriety among financial advisors to utilize this segment of the market.
Chris, John has contributed to our performance over the years, and I just wanted to make an offer out to the viewers that if they want a complimentary side-by-side comparison for a portfolio analysis, send us an email to marketinsight@gatewoodwealth.com. You'll find those details below, and while you're down there, make sure you hit that subscribe button, hit that like button, share it with friends that you think would really benefit from this video.
One thing I left out is we had significant investments with you, 2016 to 2021, and you retired. And now you're back recently, right? Only about a 1-year track record?
Exactly, yeah. 1 year.
Emerging manager now is what you're categorized as. But that's great. Well, most of the time here, we've talked about the treasury market or treasuries with some spread for corporates. We've never had a segment talking all about municipal bonds. So can you give us a little primer on the muni bond market?
Sure. Well, municipal bonds are bonds issued by state and local governments and the instrumentalities of those state and local governments. So, for example, the infrastructure assets that a state and local government would control include things like public non-for-profit hospitals. They include things like higher education, universities, water and sewer systems, electrical systems, toll roads, and something called general obligation debt. So general obligation debt would be the full faith and credit of a city, a county, a school district, or the largest being the 50 states, plus Puerto Rico, the Virgin Islands, and Guam, the United States territories. They go to finance, largely speaking, they go to finance long-term infrastructure investments. They go to finance projects which are in the public interest. And if they are deemed to be public interest and non-for-profit long-term assets, they also typically will receive tax-exempt status. So from the investor's standpoint, the tax-exempt nature of the income received on municipal bonds is one of the long-term attractive features. There are other attractive features too. Infrastructure tends to be a fairly high-quality segment of the bond market, and that government support relies upon things like tax revenues, personal income taxes at the state level, sometimes at the city level, like in New York City, corporate income taxes, sales taxes, tolls on toll roads, and fees for things like water and sewer and airports are all part of the revenue streams that go to repay these bonds. And so I think those tend to be less cyclical revenue streams. They tend to be fairly reliable revenue streams. And then finally, essential service and natural monopolies are one of the couple of the key themes that support municipal credit. That being a water and sewer system or a toll road is a natural monopoly because there's no competitor in the area typically, and that makes sense given the high capital investment. And the essential service nature, providing things like education and healthcare and police and fire for community safety. These things are very important to the population, so they tend to receive government support in a downturn, like the pandemic-driven downturn. Federal government supported state and local governments and healthcare facilities and transportation facilities to help stabilize the municipal bond market. And so those are some of the key features. I'll add one more, and that is this is a very, very fragmented market. So there are over 55,000 different individual entities that issue municipal bonds. If you add up all the individual bonds that they issue at the CUSIP level, the individual identifier of the bond, it's over 2 million. Many of which are quite small, don't trade very frequently, so it's highly decentralized and fragmented type of a market. So those are a few of the key features that I think are interesting about municipal bonds.
Yeah, when you look at the historical data on outperformance, that's what's driven to a market that's less efficient. So you can kind of see how a bunch of high yield managers like yourself are able to outperform because you have an edge in that market versus large cap managers, which in equities it's a lot more difficult. Enough of the primer. 2025 outlook. So 2024 is a tough year for a lot of muni bond managers, the industry as a whole. I know you had a great year, but what are you thinking about for 2025?
Well, 2025, I think we go into 2025 in a situation where the economy is still strong and we're close to full employment at a 4.1% unemployment rate. The economy is probably running around 3% growth. The municipal revenues, some of the revenue streams that I mentioned as a whole, are flirting around all-time record highs and continuing to grow incrementally from there. Rainy day and reserve funds are at all-time record highs in the municipal sector. There's still more credit upgrades than downgrades, and defaults are fairly rare. So from that standpoint, the credit fundamentals of the asset class look very favorable. The other key components of performance that you have to look at beyond just credit fundamentals are things like supply and demand characteristics, and then the overall trajectory and level of interest rates, and potentially Fed policy actions going forward. So taking them one at a time, municipal bond investors pulled a lot of money out of the market in 2022, and they continued to pull assets out of the market in 2023. And I think the explanation for that was really Fed policy increasing interest rates to fight inflation. And all else being equal, when interest rates go up, bond prices go down. So I think investors were sort of stepping to the sidelines, moving to a large extent, moving to cash. One of the reasons why you see record balances of money market funds at $7 trillion approximately. So some of that money is starting to go back in. And 2024, largely fairly consistent inflows. So largely fairly consistent inflows to demand, increase in demand. I think that should continue in 2025. There's still so much cash on the sidelines, and muni bond prices are essentially the reflection of the yields, and the yields of muni bonds are among the highest yields that we've seen in about 17, 18 years now, since before the financial crisis of 2008. So from a tax benefit standpoint, from a fundamental credit standpoint, And from an entry point of the yield at which investors can find, those all appear to be reasons for people to continue to put money to work in this asset class, creating a good backdrop of demand.
I want to pause there and let you get to your other 2 points, but we were some of the investors that did pull money out of municipal bonds over the last 18 months. A lot of it was that started, we saw lots of issuance coming to the market, and we saw some yields outside of the tax-exempt space that were still attractive to us. We were able to pay a little bit higher taxes, but avoid some of that issuance that came to the municipal bond market. So is the issuance coming, the supply, is that affecting your forecast for 25?
I think that, if you look at 2024, the total gross issuance of municipal bonds was $507 billion. And just to put that into some context, the last 10-year average was about $440 billion. So it was well above the 10-year average. And in fact, $507 billion is an all-time record high for issuance. Now, some of that was a bounce back from the low issuance years of 2022 and 2023, where it was below $400 billion. So keep in mind, 440 long-term average, high 300s in the year 2022 and 2023, so there was a catching up effect in 2024 at over 500. Looking ahead, now issuance should, generally speaking, grow year over year because the population of the country is growing, the need for infrastructure, education, healthcare is growing, and revenues and total national income are growing. So these things tend to have a slow growth trajectory, low single digits. Overall, taking a step back, municipal bonds outstanding are about $4.2 trillion in total size, and a lot of those issues go to simply refinance and call away other issues. So the total stack of debt outstanding for municipals has not really grown on a net basis very much over the last 20 years. It used to be that the muni market was 75% of the size of the treasury market 20 years ago. Now it's only 13% of the size of the treasury market. To give you a sense, treasuries have grown in supply, munis overall have not grown very rapidly in supply, even though we issued, as an asset class, $508 billion last year. This year, 2025, for the long-term fundamental reasons, probably issuance exceeds $500 billion again. Now, I think that can be easily digested by the marketplace if other factors are holding up. That being fundamentals, as we discussed, starting the year looking strong. Tax benefits, I suspect tax benefits are still going to be as beneficial to most individual investors in the top couple of tax brackets, and just the overall level of yield in comparison to other alternatives. And muni yields should also be looked at on a taxable equivalent basis. What do you have to earn in the taxable market pre-tax to get what you get in the muni market after tax? So those are some of the things that I think should be a good supply year and a year of overall inflows.
One of the things you mentioned was this was all based on the full faith and credit of these organizations. And we all see the headlines. I'd give C's are the ones that I would jump to. Chicago, California, especially with all the fires that are going out there. This is what you do, is you look for those high yields. So the ones there's already a little bit of doubt on that credit. What are you looking for to say, this is a Cinderella story, actually?
Sure. Yeah, so the sectors that I have been focusing on would be considered more of the high yield sectors. First of all, it's very bottoms up, but just to give you an example of a sector that is interesting would be the higher education sector. So that's colleges and universities. Now, the dynamics of colleges and universities are evolving and changing. First of all, you look at the tuition-paying high school seniors that are graduating and applying to colleges. Well, that gross number of matriculating high school seniors is in a slight decline, maybe approximately 1% per year in decline. So that means the available pool that these schools are competing for is declining. Then their preferences of these high school seniors have tended recently to be to go to larger schools with strong graduate programs, strong reputations academically, and also strong sports teams. Is really attracting a lot of those high school seniors. But there are actually 5,600 institutions out there, and the high school seniors keep applying to the same 100 to 200 schools. Of course, they don't all get in, and that's created a panic around 5,000 of the schools that thinking they're not going to have enough students to support their mission. And that is sometimes overdone. Is sometimes overdone where specific schools that have excellent endowments, very stable enrollment, valuable real estate, strong security features that are pledged to the bonds that generate inexpensive municipal bonds relative to the assets supporting them because people are nervous. Other sectors that we've continue to find opportunities in are also in the education sector are charter schools that are free for tuition for the parents and the students that go there, but provide an alternative to the local public school district and are actually funded by the state in which they reside. Of course, they're funded on a per pupil basis. So you have to have the right number of students to create the right budgetary conditions to also pay back your debt as well as manage the school itself. So management and what kind of educational opportunity you're offering the local community is really key to evaluating a charter school. So we like the education sector overall. It's very diverse and differentiated and fragmented, and there are plenty of opportunities to add value through credit research there.
That makes sense.
You had two other points that you wanted to build out your 25 forecast.
Yeah, well, the 25 forecast is also going to be influenced by the overall movement of interest rates and Federal Reserve policy. Now, interest rates are entering the year actually right around the highest levels in 14 months if you look at the Treasury market. Munis for AAA rated municipals, very, very similar, close to the highest yield levels in over a year. And that is actually a positive for the 2025 forecast because a lot of the so-called bad news for interest rates, I think, is embedded in the price and in the yield. The bad news for interest rates, quote unquote, relates to fiscal deficits, about 1.8 trillion last year. Even though we have full employment and a robust economic growth, we still have $1.8 trillion deficit. That's about 6+% of GDP, which is too high. That has been pressuring yields, in my opinion. The heavy supply of treasuries has been pressuring yields. Also, the disinflationary trends, now core inflation has gone from above 9% to about 2.5%, using the Fed's preferred measure of core PCE deflator. So that's great improvement, but just over the last several months, it's sort of been stuck above 2% and hasn't continued that disinflationary trend. And then the Fed seems very reactive. The Federal Reserve seems very reactive to the latest data point. And they kind of shift their tone from hawkish to dovish to hawkish to dovish to hawkish. And most recently, they've been hawkish in the sense of postponing further rate cuts. They cut 100 basis points last year, and the market's trying to figure out if they're still going to cut rates this year. So I think a couple of that's embedded in the price today. So that's the good news. The reason why I'm more constructive on the year as a whole, entry point. So entry point is where are yields today, where you go in. Disinflationary trend. I believe that should continue, even though there's a lot of debate around it. But there are many reasons, but just one of the reasons why I think that should continue that I want to highlight is that most of the differential between the target of 2% and the actual of 2.5%, that differential is being driven by something called owner's equivalent rent. So if you rented out your house, what would you get in monthly rent? That's a very important statistic, but it's also very lagged, and we believe that it's about 6 months behind actual market conditions, and we think actual market conditions are coming down in the rental market, which will eventually feed through. And along with other factors, we think that we will be able to say the disinflationary trend is continuing, which should enable the Fed to cut this year. And right now, there are no cuts priced into the market this year. So if they do cut, that would be very helpful to the bond market. And then finally on the deficit, no one gives any credit for potential cost cutting or the benefits of deregulation as of yet. It's still early. Trump hasn't even taken office yet, of course. And tax receipts at the IRS, I think that they should be very, very strong this year and have some nice upside versus 2023 tax year. We're collecting on 2024 tax year starting April 15th. I think that's going to hit new all-time record highs and should, at least on the margin, help alleviate some of these heavy issuance pressures coming from the deficit. So I think there's some potential good news that is being ignored right now. And that should keep rates more stable with even a potentially a little bit of a decline in longer-term interest rates. So it's mostly a yield story, but we think that through credit selection we can add some value on top of the yield that we are distributing.
Yeah, one other interesting thing you said about the inflation, you are starting to hear more of the Fed speakers saying the actual inflation numbers look good. Some of the imputed numbers, like you referenced, owner's equivalent rent isn't a real number, right? It's an estimated number, were what was holding them back from some of the disinflation, and some of the actual numbers did show disinflation. So I think that's a little bit about what you were saying. We're running out of time. I wanted to make sure while you were here we did cover the hottest thing in fixed income, and that is private credit, private debt. You know, I work with the St. Louis CAIA Association. Every CAIA chapter is doing private credit events, and they're out the door, fully standing room only at their events. It's a lot of what people are talking about. What is your opinion on what's happening in private credit?
I'm seeing the same exact things that you're referring to, that you are seeing. And it does make one a little bit nervous that that is getting such a hot area, and there is so much demand. Now, if this area is managed well, I think very favorable returns, around 10%, again taxable, are feasible and should continue to be feasible. Just a couple of things that you have to watch out for is that generally speaking, most of these vehicles have lockups, so you're not going to be completely liquid at all times. That's pitched as a positive because the portfolio management team can invest for a longer term without having to worry about daily trading or daily redemptions. So just something to be aware of. I do think that from a long-term secular basis, and why is this market experiencing so much growth and so much demand, it is the risk reduction theme in the banking industry, which is really continues, has caused banks to pull in their horns in certain types of loans, and the demand from the borrowers to borrow in certain types of loans has not been met by the major banks or even by regional banks. So therefore, I think the supply of relatively solid, reliable type credits at, call it 9, 10, 11% yields in some cases, they would be, a good manager would be lending against some pretty solid credits at potentially close to double-digit yields, and a good manager can also manage default rates to a modest level. Generally speaking, these are mostly floating rate, so if the Fed does cut, you're not necessarily going to see any total return benefits from that. And there is some opaqueness regarding mark-to-market and pricing, because there's not the vehicles aren't necessarily liquid all the time. So I think there are some cautionary notes when you see extreme demand for products that are locked up. but with a good manager and good selection, it's a nice source. It's a nice source of income that I think is supported by solid credits if you're seeing that kind of the right type of supply.
Perfect. John, thank you so much for joining us. We'll be back next month. We're going to do a little bit of a market update and bring on some of our financial planners to get financial planning ideas for 2025.